The IRS just quietly released a brand new tax form that could save you thousands of dollars. But there's fine print that most people are completely missing. If you earn tips or work overtime, the next few minutes could be the most profitable of your tax season. In this video, we'll break down exactly how the new no tax on tips and no tax on overtime deductions work, and show you step-by-step how to claim them on Schedule 1A. We'll clarify that these are deductions from your taxable income, which significantly impacts your actual dollar savings. If you find this helpful, consider subscribing for more straightforward financial breakdowns like this every week. Drop a comment with your biggest question about these new tax breaks. Now let's dive into Chapter 1, the One Big Beautiful Bill Act, a closer look at your new deductions. The IRS has introduced Schedule 1A for the One Big Beautiful Bill Act. This act brings some exciting new deductions, especially for service workers and hourly employees. We're talking about no tax on tips, up to a $25,000 cap, and no tax on overtime, with limits of $12, $500 for single filers, and $25,000 for joint filers. But here's the crucial distinction. These are deductions from your taxable income, not exemptions from tax altogether. What does that mean in plain English? A $25,000 tip deduction, at an effective tax rate of, say, 20%, actually saves you around $5,000, not the full $25,000. It's still significant savings, but understanding this difference is key to knowing your real benefit. The IRS has introduced new avenues for potential tax savings beyond just tips and overtime, with the recent passage of the One Big Beautiful Bill Act. Two notable deductions now available are for car loan interest on new, U.S.-assembled vehicles and an additional deduction specifically for seniors. Understanding these can significantly impact tax liabilities for the upcoming filing season. Consider the car loan interest deduction. This provision allows taxpayers to deduct interest paid on the financing of a new vehicle, provided it was assembled within the United States. This is not an unlimited deduction. There's a cap of $10,000 in interest that can be claimed. For instance, if a new U.S.-made car buyer accrues $4,000 in annual interest on their loan, this could translate to a tax saving of approximately $600 to $800 for someone in the 15 to 22% tax bracket, according to analyses by CNN and CNBC. Furthermore, the Act introduces an enhanced deduction for senior citizens. This additional deduction can provide a substantial benefit, with amounts of $6,000 for single filers and $12,000 for those filing jointly. This is designed to offer further relief to older taxpayers. Did you know that the AARP Tax Guide highlights how these deductions, when combined, can create a more favorable tax outcome? It's crucial to remember that these are deductions from taxable income, not complete exemptions from tax. This distinction is vital because it affects the actual dollar amount saved. For example, a $25,000 deduction at a 22% tax rate saves roughly $500, not the full $25,000. The IRS has introduced Schedule 1A, a new tax form designed to help individuals claim deductions related to tips and overtime income. This form, stemming from the One Big Beautiful Bill Act, allows for significant savings, particularly for service industry workers and those with hourly wages. It's crucial to understand that these are deductions from taxable income, not exemptions from tax liability. For instance, the $25,000 cap on tip income deductions, when applied at an average effective tax rate of 22%, translates to a real tax saving of approximately $500, not the full $25,000 itself. Is this distinction clear? With the 2025 tax year, W-2s will not provide a detailed breakdown of tip and overtime earnings, meaning calculations must be made manually from pay stubs. Gathering these figures beforehand is essential for accurately completing Schedule 1A. What specific information should one look for on these stubs? Pay stubs typically itemize regular wages, overtime pay, and any reported tips. For example, a server earning $15 per hour with an additional $10 per hour in tips, working 30 hours a week, would need to aggregate their total tip income from all pay periods. This aggregation is key to determining the deductible amount. Furthermore, income limitations apply. The deduction for tips is subject to a modified adjusted gross income (MAGI) phase-out, beginning at $150,000 for single filers and $300,000 for those filing jointly, according to IRS.gov data. Failing to account for these phase-outs can lead to an incorrect claim. Did the legislation mention any other deductions that might be relevant? Yes, the One Big Beautiful Bill Act also includes a deduction for interest paid on new car loans, capped at $10,000, but with a critical stipulation: the vehicle must be assembled in the United States. This detail, often overlooked, means interest on used cars or imported vehicles does not qualify. The IRS has introduced a new form, Schedule 1A, designed to help individuals claim significant tax deductions. This form is crucial for understanding the implications of the One Big Beautiful Bill Act, particularly for those who receive tips or work overtime. Millions of service industry workers and hourly employees may be overlooking substantial savings simply by not knowing how to navigate this new filing requirement. So what exactly are these deductions? They include no tax on tips, up to a $25,000 cap, no tax on overtime, with limits of $12, $500 for single filers, and $25,000 for joint filers, a deduction for car loan interest, capped at $10,000, and an additional deduction for seniors amounting to $6,000 for individuals and $12,000 for couples. It's important to remember these are deductions that reduce taxable income, not exemptions from taxes altogether. This distinction significantly impacts the actual dollar amount saved. For instance, at an average effective tax rate of 20%, a $25,000 tip deduction translates to approximately $5,000 in savings, not the full $25,000. Filling out Schedule 1A requires careful attention. Since 2025 W-2 forms were not updated to reflect tip and overtime breakdowns, individuals must calculate these amounts themselves using their pay stubs. The form directs filers to specific lines for these deductions, and retaining supporting documentation, such as detailed pay stubs, is essential for both manual and electronic filings. These deductions can be claimed electronically through popular tax software. However, several fine print details can affect eligibility. For the tip deduction, there are modified adjusted gross income (MAGI) phase-outs, $150,000 for single filers and $300,000 for joint filers, according to IRS.gov. Furthermore, the car loan interest deduction applies only to interest paid on new vehicles assembled in the United States, with a $10,000 cap. A valid Social Security number is also a requirement, excluding those with an ITIN. Missing the April 15th deadline means forfeiting these potential savings. Consider a waitress earning $40,000 annually with $20,000 in tips. She could see an approximate tax saving of $3,000. A nurse working 10 hours of overtime weekly at $35 per hour might save around $1,875. And a new car buyer with $4,000 in annual interest on a U.S.-made vehicle could save between $600 and $800. Stacking multiple eligible deductions can lead to considerable financial benefits. To avoid denial, 3 common mistakes must be avoided. First, exceeding the MAGI limits without realizing it. Second, incorrectly claiming car loan interest on used or imported vehicles. And third, failing to provide adequate pay stub documentation for tip and overtime amounts. Filing before the April 15th deadline is critical for claiming these benefits. The IRS introduced Schedule 1A, a new tax form that could offer significant savings, particularly for those who earn tips or work overtime. This form, part of the One Big Beautiful Bill Act, allows for deductions previously unavailable, but understanding its nuances is crucial for maximizing the benefit. For instance, the deduction for tips has a cap of $25,000. However, this is a deduction from taxable income, not a direct tax exemption. Considering the effective tax rates faced by many, this $25,000 deduction translates to actual savings of approximately $3, $750 to $5, $500, rather than the full $25,000. This difference arises because the deduction reduces the amount of income subject to taxation at a specific rate, which, according to IRS data for 2025, typically falls between 15% and 22% for many individuals. Furthermore, eligibility for the tip deduction is subject to income limitations. Individuals filing as single may see the deduction phase out if their modified adjusted gross income, or MAGI, exceeds $150,000, while joint filers face a phase-out above $300,000. A surprising number of individuals may unknowingly exceed these thresholds, thereby reducing their potential savings. For example, a single filer with a MAGI of $160,000 might not be able to claim the full tip deduction, a detail often overlooked in initial calculations. This income phase-out is a critical piece of fine print, as highlighted by analyses from sources like CNN. The IRS has introduced Schedule 1A, a new form designed to help millions of service workers and hourly employees potentially recoup significant tax savings. This form specifically addresses deductions for tips and overtime earnings, and while the April 15th deadline looms, many are overlooking critical details that could diminish or negate these benefits. A common misconception is that these deductions eliminate tax liability entirely. In reality, they function as deductions from taxable income. For instance, the $25,000 cap on tip deductions, when applied to an individual in a 15 to 22% effective tax bracket, translates to actual savings of approximately $3,750 to $5,500, not the full $25,000. Furthermore, eligibility for the car loan interest deduction comes with specific stipulations. This deduction is exclusively for interest paid on new, U.S.-assembled vehicles. Claiming this benefit on used cars or imported models is not permitted. Did the average car buyer understand this nuance before? Another crucial requirement is a valid Social Security number, or SSN. Individual Taxpayer Identification Numbers, or ITINs, are not accepted for these deductions. And critically, all claims must be submitted by the absolute April 15th filing deadline. Missing this date means forfeiting these potential savings for the tax year. The IRS has introduced Schedule 1A, a new tax form designed to help millions of service workers and hourly employees potentially reduce their tax liability. This form specifically addresses deductions for tips and overtime earnings stemming from the One Big Beautiful Bill Act. It's crucial for individuals to understand that these are deductions from taxable income, not exemptions from tax altogether, which significantly impacts the actual dollar savings realized. Consider a waitress earning a base salary of $40,000 annually with an additional $20,000 in tips. By accurately claiming these tips on Schedule 1A, she could see a tax saving of approximately $3,000. Isn't it remarkable how overlooked income streams can translate into substantial refunds? Now let's look at a nurse who consistently works overtime. If this nurse averages 10 hours of overtime per week at a rate of $35 per hour, the annual overtime earnings could lead to a tax reduction of around $1,875. This illustrates the power of documenting and claiming every eligible dollar earned. For those who have recently purchased a new car, there's another potential benefit. A new car buyer who incurs $4,000 in annual interest on a vehicle manufactured in the United States could save between $600 and $800 on their tax bill. These savings can really add up when multiple deductions are combined. It's important to be aware of the fine print. For instance, the tip deduction has income phase-out limits, set at $150,000 for single filers and $300,000 for joint filers. Furthermore, the car loan interest deduction specifically applies to new vehicles assembled in the U.S. and requires a valid Social Security number. All data is sourced from irs.gov and the text of the One Big Beautiful Bill Act. The IRS has introduced Schedule 1A, a new form designed to help millions claim significant tax deductions related to tips and overtime. For service workers and hourly employees, understanding these new provisions is crucial for maximizing tax savings before the April 15th deadline. It's a common misconception that these breaks eliminate tax liability entirely. In reality, these are deductions from taxable income, not exemptions from tax, and this distinction significantly impacts the actual dollar savings. For instance, a $25,000 tip deduction at an effective tax rate of 15 to 22% translates to savings of approximately $3,750 to $5,500, not the full $25,000. One critical pitfall is exceeding the modified adjusted gross income, or MAGI limits. For the tip deduction, this phase-out begins at $150,000 for single filers and $300,000 for those married filing jointly. Did you know that claiming car loan interest on a used vehicle, or one not assembled in the United States, will lead to denial? This deduction is specifically for interest paid on new vehicles manufactured domestically. Furthermore, meticulous record-keeping is paramount. The W-2 forms for 2025 were not updated to detail tip and overtime breakdowns, meaning taxpayers must calculate these amounts themselves. Having detailed pay stubs to substantiate these figures is essential, as lacking this documentation is a primary reason for denied deductions. For example, a waitress earning $40,000 with $20,000 in tips might save around $3,000, but only if these amounts are properly documented. As the April 15th deadline approaches, taking the time to accurately file Schedule 1A and gather necessary pay stub documentation can prevent these common mistakes and ensure the full benefit of these new tax provisions is realized.